Hello, everybody. Welcome to this new webinar of Investor Horizon. We're here today with Mikko Suonenlahti. We're here to discuss what is needed to get to a Series A funding. I am Perrine. I'm project manager at the European Business and Innovation Centers Network, the EBN. We are a partner of Investor Horizon, a project that is financed by both the European Commission and the Eureka program. This project was launched in June 2019 with the ambition to deliver an accelerator that can host up to 500 deep tech SMEs until the end of this year. This accelerator program is always open for application. We have a running platform and we have cutoffs every 3 to 6 months. So if you're interested in the program, I encourage you to check our website. The next cutoff is on February 7. If you are selected into the program, you spend about 4 to 6 months in the accelerator. Here are the key criteria to consider. If you want to join the program, you have to be a deep tech company seeking for a Series A funding. You have already secured a seed funding and you are based in an EU country or in a Eureka country. We have a bit of data now. We have more than 300 companies that have been accelerated or that are currently accelerated in the program. On a sample of 130 companies, 25% already managed to raise some investment. So if you have an interest in this program, I really encourage you to check the website and look at all the information we have. We have also monthly webinars. The next one is on the 4th of February. They are really short sessions where you can also learn a lot about the program and the application process. You can register, you can just access it online. And we also have a lot of resources on this website. Investor Horizon has a lot of online classes that are available for free. And we have obviously these webinars that we are also delivering every month. The next one will be on March the 3rd, and you can already register. I'm coming now to our point and our topic of today, how to get to a Series A funding. I'm here today with Mikko Suonenlahti. Mikko is also an expert and a coach in the Investor Horizon program. He is a business builder and is on the board of several companies. Mikko has more than 35 years of startup experience and he's been on the board of about 100 businesses across the US and Canada and Europe. So we're here in very good hands. You will have, Mikko will have about 30 minutes to present and give you very practical advices on how to get to a Series A funding. And you will then have the opportunity to ask your questions to Mikko at around 4:30, 4:35. We will go through the Q&A. What I would like to encourage you is starting to ask your question during the presentation, so we have time to go through the questions. We also received a lot of questions before this session, so I would like to thank you for that. And now, Mikko, I'm going to give you the floor. I'm going to stop sharing my screen.
That's great. Thank you, Perrine.
I will give you a heads up when you have 5 minutes, 10 and 5 minutes left. So you feel.
Right. And just to double check, do you see my screen now?
We see your screen fine.
Thank you, Perrine, very much for your kind introduction. This is the 3rd year that I'm doing this presentation, which Invest Horizon asked me to do in 2019. And it's been impressive working with Invest Horizon for the last 3 years. As Perrine mentioned, more than 100 companies have received funding of more than 50 million euros who have participated in the accelerator. And I think the popularity of this event is also seen by how many participants we have today, and it looks like it's quickly approaching almost 100. The first time that I held this presentation was in Milano in November 2019, and the day before, one of my pre-revenue stage companies was acquired for 1.4 billion US dollars. I will be using this company, Carbonite, as a case study on how to go all the way from pre-revenue to being acquired for more than $1 billion. Then, just a few weeks ago, another one of my companies made the news, a Finnish company called M-Files. They secured an $80 million or about 67 million euro funding, which is part of the growth story, similar to what Carbonite had done. Moving on to the Carbonite case, this is how their revenue developed. Back in 2006, when it was still a pre-revenue stage company, I led the first institutional financing round from a venture capital fund. They raised €3 million, euros, of which I took half for the fund, with a post-money valuation of 17.17 for a pre-revenue stage company. And what you can see is when Carbonite launched its SaaS software product, they quickly continued raising more money in 07, 08, 09. Here you can see how revenue developed, and you can also see how much money they raised every year and what the post-money valuation of Carbonite was. The big point here being that most of the funding went into lead generation, business development, and sales in order to ramp up and grow faster quarter by quarter. The story continues, and then in 2011, which is about 5 years since my initial investment, they were able to do an IPO in Nasdaq in the US, and based on 6-month figures of 19 million in sales and making a loss of 7, they raised 44 million with a post-money valuation of 264 million euros. So this is a story, this is a financial story which many of the previous 130 investment horizon accelerator companies, I'm pretty certain that there are several in that batch that are able to follow a similar financial track as here. And if I look at the names of the companies that are present today in this event, I'm certain that there are several companies who are able to build this kind of a historical financial model going forward. Here's Dave. Dave is the founder of Carbonite. And when I look back at his career, it's the kind of a career that I would propose and suggest that European technology founders of companies do. And what it is, become serial entrepreneurs. Dave raised his first Series A when he was 23 years old, and he's been doing this for 45, 50 years. 2 of his companies have done an IPO, and now he's working on a company called Wasabi, and the Series A there was $68 million. Nicest possible guy, and I would just like to use Dave as a reference when you think about your own careers as founders of technology companies, to think about it as a 10, 20, 30, 40-year career where you become founders of not just 1, but 2, 3, 4, 5 technology startups. A couple of words about me. I've been working with founders of tech companies for 40 years, since 1983. As you can see from the pictures, I take some risk also during my time off, but calculated risk. And as Perrine mentioned, 4 of my pre-revenue investments have been acquired for more than 2 billion euros, which includes 2 IPOs in the US. I've served on the boards of more than 100 venture capital-backed companies in the US and in Europe, and I've gone through 5,000 investor presentations. It's based from this cumulative experience that I've pulled together this presentation. So, going into the topic. One of the key messages I have is the interrelationship of your investor presentation, your fundraising strategy, your board meetings, and your exit ideas. First of all, I'm big about an investor presentation, including a financial plan. And in addition to a couple of slides in the investor presentation about your financial plan, you should be prepared and have a full Excel, including profit and loss statement, balance sheet, cash flow. I've included my thoughts about an investor presentation in the appendix of this slide presentation and will not be going through my 10-point investor presentation framework, but it is included in the appendix. My key message is think about the financial plan as well as the actual storyline, because it's the financial plan that your investors will be buying ultimately. Speaking of the financial plan then, there's a clear link between your CRM, meaning your marketing pipeline, and your sales pipeline, especially if you are at a pre-revenue stage. I would be very keen to take a look at your CRM and see how many millions worth of possible business do you have in your marketing and sales pipeline, because that's about the only way that we're able to make some kind of a link through your numbers into a financial model and top line revenue. KPIs should be thought about as well. And many of you are SaaS software companies, so I've included a SaaS exam as a slide in the appendix. I will not be covering that more than just mentioning that there's some interesting material for SaaS companies in the appendix. Then there's the financial model. Once you come up with a 3-year collapsed income statement, it's pretty easy for a professional investors to come up with valuation ranges. The financial model should also include your hiring plans. And then, similar to Carbonite and what David Friend has been doing, I would speculate that those companies who are here today who want to create shareholder value of in the tens or hundreds or even in the billion euro range, I would think that you would need 2 to 4 financing rounds during the next 3 to 5 years for a total of 10 to 40, maybe even much more, in order to generate that shareholder value of hundreds of millions of euros. It cannot be done through operating financing. Then many of you would ask me, well, what about the exit and exit planning? And many VCs will ask you, what are your thoughts about exit? I would not be that worried about your exit, because if you execute your financial model, if you continue growing 30 to 50 to 100% per year, the exit will materialize one way or another 3 to 5 years down the road. So I would not spend too much time thinking about the exit. You could, though. You could think about companies in your broad ecosystem that are acquisitive, and do mention those to the VC if they ask for exit ideas. But I would not spend too much financial modeling. It's their job as an investor to do that. And you could easily say that, hey, I'm planning to do an IPO in 5 years. I expect to need 2 to 4 rounds of capital, 10 to 40 million euros, if the question is asked, or what your thoughts are on where you could take your company to. fundraising strategy. Many of you will be asking me the question, well, Mikko, how much money should I raise? And my answer is, the answer is in the financial plan. So if you show me your 3-year income statement, your EBITDA, your negative EBITDA will be pretty close to cash, and it's pretty close to the 3-year cash need that you have, plus a 6 to 12 month reserve if your sales do not come in as soon as you plan to. And for some of you companies, especially medical devices, there may be some investments that you need to do in the balance sheet. But roughly speaking, it's the financial plan, it's a negative EBITDA, and you need to cover that negative EBITDA with funding one way or another. Many of you will also be showing a hockey stick in sales 2 to 3 years down the road. I would be careful about showing excessive growth numbers, because you should be comfortable executing and meeting whatever numbers you show. And the financial plan with that hockey stick, in some cases, it may become a legal appendix of a shareholders agreement, which I'm not sure you want to see happen. So be realistic, be conservative about the financial plan. If you grow 30 to 50% per year, I think that's a good job. Some of you may be growing 100% per year, but in my mind, you don't need to triple or quadruple your sales every year going forward with your initial Series A funding. Interestingly enough, when you start meeting with investors, and some of you may be raising 1 to 3 million from business angels, some of you may be raising 1 to 3 million, maybe 5 million from venture capital funds, or maybe from corporate venture capital funds. The point being, think through your fundraising strategy and what kind of investor suits you best. When you get to that meeting, suddenly it's not any more important what you have contextually in your investor presentation or your financial plan, but it's how you present. It's your personalities, it's your charismas, it's your understanding of the broader ecosystem, it's your team that suddenly makes the needle move on the investor side. So it's what I call words, music, and dance. And suddenly, when you're at the meeting, all of that may be just as important as the pitch deck and the financial model that you've created. Moving on. Cap table. Effectively, what a cap table is, if somebody wanted to acquire a company today for 10 million or 100 million cash, and you would agree to that exit, the proceeds on the table would be divided according to the fully diluted cap table. So it includes your shareholders, it includes your options, maybe warrants. It would include liquidation preferences that some of your investors may have. It may include interest on those liquidation preferences. It would include convertible notes on a as converted basis, including interest of those, and so on, so on, so on. The point being here is that the cap table initially starts as a small Excel sheet, a couple of lines, a couple of columns, but every time you have something impacting your cap table, you need to add line items and you need to add columns. And then 3 years, 5 years down the road, you still have that same Excel sheet, but it will be a pretty complicated Excel sheet to really come down to the fully diluted position that your cap table has. But you need that. If you have to do it in a rush for your investor who's asking for it, it may take time to pull it together. So I would recommend that as an action point, if you do not today have a fully diluted cap table ready, do make some time in the near future and update that cap table and keep it updated as you move forward with new investors and new financing rounds. So think about it as a pizza that is on the table, and how do you slice the pizza amongst your shareholders? That's pretty enough said about cap tables. Next point, the term sheet. There are many different kinds of term sheets out there. There are many different kinds of investors out there. And there are many things that as founders of companies you should look for. I would recommend that all of you understand every single sentence, every single comma, every single period of the term sheet that you eventually get. On top of that, I would expect that all of you would want to have a venture capital lawyer helping you with the term sheet and the upcoming shareholders agreement and investment agreement. They are complex documents. You need to understand them. And the kind of a lawyer that you need is not someone that technically says, well, that's the kind of a term sheet that I've often seen. What you really need is what I call a street fighter, somebody that will really push for every single term on the term sheet for your benefit with the VC funds or the angel investors lawyer in order to get you to a best possible term. There are quite a few things in the term sheet that are much more important than just valuation. I worry about control clauses, and you should clearly understand what the control clauses are that a VC or an angel syndicate is proposing to you, and I would push back as hard as you could. There are a couple of terms that I would propose that you never ever agree to, although they may be asked for. One of them is founder vesting, which in my mind is a no-go for founders. Basically what it means is that the investor would insist that you re-earn again your own shareholding during the next 2 or 3 or 4 years. So keep careful with that term. Ideally, get it out of the term sheet or negotiate and push hard. Then there's something I call a forced exit clause. And what it is, the investor will pay you the valuation that you want, but then they'll have a forced exit clause, which means that 3, maybe 5 years down the road, they can bring a investment banker and sell your company, and they get to decide what the valuation of that exit is. You don't want that to happen, especially as you should be in the majority as founders of your own company. So these are just a couple of pitfalls. There are many others that you should be aware of, and you should be prepared to push back as hard as you're able to and negotiate. One more point about the term sheets. I quite often see non-binding term sheets, and then sometimes I see binding term sheets that are based on due diligence. The way I would construct a term sheet and push back is that, look, you have to ensure that the investor has completed business due diligence before they sign a term sheet. And assuming that there are no material findings in financial due diligence or legal due diligence, that term sheet should convert to a binding agreement. So that's one more tip for many of you out there looking for your next term sheets. Due diligence. There are many kinds of due diligence processes that an investor may do. Probably not all of these that are mentioned here. Business due diligence would be very important, if not the crucial. I've also seen investors do technical due diligence. In one of my companies a few years ago, an investor proposed to invest 3 million euros at a pre-money valuation of 17, meaning post-money 20. And then they had an outside consultant doing technical due diligence. And the result was that they said that the technology would not scale to large volumes. And they said it will take about 500 to 750,000 euros and 9 months of time to redo the core code. We're happy to continue funding the company, but we will drop our pre-money valuation from 17 to 15. And if you have 6 weeks of money left in your balance sheet, you don't have many options except agree to that. So think about technical due diligence. Increasingly, do think about cyber due diligence, which is a new one that I've seen during the last year or two. The investor, they want to make sure that you are well protected against any kind of cyber attacks coming out from the blue. Then there's legal due diligence, mainly your corporate governance items, which should be shipshape, financial due diligence, and then also due diligence on your intellectual property, or if you have patents, then a patent search and a freedom to operate search. So much for due diligence. Moving on.
10 minutes,
Shareholder,
Mikko.
10 minutes. Thank you, Perrine. We have points 8, 9, and 10 still to cover. There's the shareholders agreement. And in some cases, not often, but every now and then, I've seen that the investor presentation becomes a legal appendix of a shareholders agreement. I've seen the financial plan become a legal appendix of a shareholders agreement, the business plan, and also the KPIs. So be careful with your investor presentation and your financial plan, because they may become legal documents. And at some point, the investor may go back to those initial documents and say, hey, what's going on? And as I've said over and over again, I do worry about the control clauses, but my point is push back in a nice way, but in a persistent way. Corporate governance. The way I would think about your board meetings and your annual general meetings or your extraordinary general meetings, for founders and CEOs, at the end of the day, they are all fundraising events. There you're able to convince in a good way your existing investors and shareholders that, hey, it's worthwhile continuing to invest going forward in your company. It's important to have a good agenda for your board meetings. Who drives the agenda? The role of the chairperson is important. In the US, a founder would quite often be a CEO and chair. In Europe, many VC funds would rather insist that there's an independent chairperson or someone else and a founder becomes a chairperson of the company. But the role of the chairperson together with the CEO is pretty crucial in driving the agenda of those board meetings. So where does my time go to in the 100 and more venture capital backed companies that I've served on the boards of, or the 8 companies where I'm now on the board? I would say that most of my time on the boards and between the board meetings, they go into go-to-market discussions. Even with my bigger companies that have 50, 65, 75 million euros of revenue by now, it's a continuous go-to-market discussion. What could we do better? How could we change before you're really able to find a scalable business model? So be prepared for that discussion and be prepared to test things in your business model. Invest in something. If it works, invest more. If it doesn't, pull out and invest somewhere else. So that's just a personal observation from my board work. And then obviously the financial plan and eventually your IPO readiness plan, they all link together. And at the end of the day, it's all about execution of your financial plan, starting from the very first day when you raise your Series A funding. Very last point, once more about the exit. Yes, it can be done. I've had quite a few of my seed stage companies being acquired for tens of millions of euros and dollars, whether they're pre-revenue stage or whether they have some revenue. So an exit could happen out of the blue, basically any time. So in a way, be prepared for that, be on the lookout. But I would say that companies, they get acquired. It's very difficult to sell a company. And if Dave, who's now pushing in his mid-60s, if he has been an entrepreneur and a serial entrepreneur for 45, 50 years, I believe all of you are able to do that just as well. and I would like to see many of you become serial entrepreneurs, and I believe that many of you will eventually come up with companies that will do an IPO. So thank you very much for this. It can be done, but you do need funding to make money. And as I said earlier, I would expect that you need 2, maybe 4 financing rounds during the next 3 to 5 years in order to build shareholder value of in the tens or hundreds of millions of euros. It can be done. Let's do it. It's all about teamwork. Thank you very much.
Thank you, Mikko. Perfect timing. Mikko, we've got a lot of questions. Okay, I'm going to go through the question. How would you see innovation, product development portfolios value important in Series A funding?
Right. I think that's a great question. And especially if you are in a pre-revenue stage, or if you've barely broken into new revenue, I think some investors will think, rightly so, that it's all about the innovation, it's all about the IP, the intellectual property, where the value of the company is. There's a couple of things that I encourage founders and entrepreneurs to do. Think about how much money has been invested into your IP during a university stage or during an accelerator stage. And when you do the math quickly, you may be able to come up with a figure that, look, hey, maybe there's 10 development years gone into the product before revenue. So simplistically, 1 development years, in my mind, is equal to about 100,000 euro investment. So if you have 10 development years of IP, that's about €1 million, which somehow sets a floor for your valuation. I've seen pre-revenue companies that have 25 development years behind them, everything considered, including universities and so on. And then my style of investing, what I look for is, and this could even be a slide in your investor presentation, in addition to the IP slide, I would have a slide that describes your system architecture, and I would use a title which would be high technical barrier to entry. So there needs to be complex technology that you've developed, which is unique in the world. Thank you.
Thanks, Mikko. In certain industries, for example, in the medtech, the product development is much longer than in the SaaS products. So companies are often forced to start fundraising before the KPIs have been fully met.
Yes.
Any advice on that?
Right. And it's an absolutely correct observation, especially if I think of medical device companies that are here today compared to SaaS software companies, or if I think of pharmaceutical drug development companies, they will have very, very different requirements for funding, and even for funding for their first product launch. And if you're in the pharma industry, you could easily need several hundreds of millions of euros of funding to get to a product over 10 years, let's say. And then at the other end, you may have a SaaS software company with 2 technology founders. They've been working at the minimum viable product for a year, and maybe they've already been able to break into first customers and are ready to raise. So absolutely, yes, there's a big difference depending on the sector that you're in, which means that when I threw up the numbers, you need 10 to 40 million over 3 to 5 years. That would be true for software companies, but not necessarily for the hardware companies or the medical device companies or the pharma companies here.
Mikko, is it realistic to keep the majority of the company after several rounds?
Right. So I guess my role, and I've been independent for 10 years now on my boards, my role is almost always to work for the founders, and in a way, all of us are working for the founders and support the founders who are executing. in executing, in solving a new problem with a new value proposition. Some venture capitalists think that the founders need to have more than half, or the founders and the management team need to have more than half, or 50% of the company before the A round. I would almost push that further along and say that, look, ideally, after the A round, the founders should still have more than half of the company. It's a give and take. It's a bizarre discussion. And it's one of the many important points in your term sheet that you need to push back on, and you need to be careful about valuation. Having said that, valuations today in Europe, they are higher than they've ever been before, and there is more money in the market today than ever before. I look at not only the demand of money from the perspective of technology startups in Europe, but also from the supply of capital, the other side of the coin. And there's record amounts of cash out there looking to invest, whether it's angels or whether it's venture capital funds. They all have their pockets full of money today. It's an excellent time to go out fundraising. Valuations are high. There's good capital in the market. It will not always be so. My first interactions in the venture capital industry were in the late 1980s. And what I've observed since then, that venture capital, supply and demand, and how the M&A market or the IPO market evolves, they can be highly cyclical. The supply of capital has increased for more than 10 years since the financial crisis. And my DNA tells me that it will not continue to grow for the next 10 years or even 5 years. So I'm more bearish than bullish on how long can this excess capital period last. But while the money is out there, go for it.
Mikko, if you have had a small scale lifestyle company for 10 to 15 years and you want to scale up only now, is it possible for Series A funding and the steps following?
Right. So if I may play back, Mary, the question, it was regarding a life sciences company and the long-term funding and how that relates to Series A today. So absolutely, yes. Now, when you're a life sciences company, that's one area where I would certainly recommend that you speak with corporate venture capital funds. But there again, it's a delicate balance on how much do you raise from corporate venture capitals. Do you let them onto your board or not? And what your valuation are, especially because it may take that 5 years, 10 years, or even longer to develop product. It's a careful balance, and you just need to negotiate as hard as you're able to in the early stages of your company.
Mikko, you're saying it's a good time to raise money. It's quite nice to hear that. It's a bit like surprising in a way. It's coming up as a very recurring question. Sounds simple, but how do you access investors and how do you find like these investors? Is it just like Googling, or do you have to ask all your contacts? What is the best strategy you have to have there?
Right, that's a great question. There are many events in Europe, almost on a monthly basis, where venture capital funds and the partners and associate there go to look for new deals. And that's one way. And doing a Google search is another way. And you should certainly do your due diligence on the venture capital funds. We discussed earlier that they will do a lot of due diligence on you and your technology, but you should do very careful due diligence on your investor, on who they are, how do they behave on boards, are they really able to add value or not. But the big question I think I heard really was, well, how do you find the right investor? It's all about networking. It's all about establishing those connections. And I think what the question also alluded to is, how long does it take to get funded? And my answer is, it'll take just as long as two people that are strangers to each other. How long does it take for those two persons to trust each other? So if you think about a venture capital fund and an investment in a company, it may be 7 years, it may be 10 years before you have an exit. So you may have to get along with each other for the long term. But you need to do your own basic research on where to find those VCs or the angels. Go to events, start networking. Yes, use Google, and there are the business angel community in most European countries are quite well organized. So a good starting point would be your local business angel network or association, and just introduce there. Now, what do you need for those interactions? What you need is an investor presentation and a financial plan. I'm not going to go through an investor presentation and a financial plan today. That's a whole other half-day discussion, but the framework is included in the appendix, so take a look at that. You can always get the door open once with an investor. And when you do that, I would recommend that you are ready to pitch. Your investor presentation is very well thought out, and you have an excellent financial plan. You can get it open once, but quite often not a second time.
Okay, we have here a related question in a way. In your opinion, Mikko, how easy or difficult is it for people of color or for women-founded tech companies to get investment? Are there any tips to overcome any barriers?
Right. I have backed several women founders, and I'm in discussions at the very moment. I don't see any problem with that. On the contrary, I think the overall sentiment is just as open to women being founders of companies as men. It's changed. 3 years ago, 5 years ago, it was not the same situation, but I think the sentiment is going in that right direction. I'm a strong believer of diversity, not only in the management team. 10 years ago, 15 years ago, it used to be 4 software developers who all had long hair and who all had long beards, and they would not talk a word, but they had the best software in the world. I think that has changed, and I think most of us are strong believers of diversity in management teams, in founder teams, and also in your boards, because there is tremendous value to be had when you have a diverse founder team, including women and people that are not only software engineers, but the same goes for your board. And there are networks and organizations out there for women founders. So start with that.
Thanks, Mikko. We have a lot of questions. I'm doing my best to go through the questions. Do you recommend to create a spin-off for a specific investment for a company that has a portfolio to focus the investor in that specific product?
Right. Short answer, absolutely yes. And if you have several products or several business models in your company, I would expect that if you split them into 2 companies, that they would both have a different funding story ahead of them. They may have a different exit path. And many investors may come into a company saying, look, I would want all of my money to go to this one product, but not the other one. And then you may have another investor that says exactly the other way around. So what will you do? And what I've done every now and then, not that often, but every now and then, I've split companies into 2. It can easily be done, but you need some professional advice from your auditor and from a lawyer on how to split a company into 2. The short answer is yes. I also see every now and then with very early stage companies that they're trying to do 2 business models at the same time. They're trying to do B2B, business to business, and at the same time, they're trying to do B2C, business to consumer. And I'm telling them that, look, I can easily help you raise capital, but you need to make the decision now before we start to fundraise. Are you going to focus on B2B or B2C? And at the end of the day, I don't care what the decision is, but I would push for them to make that call and focus on one, because you need very different skill sets depending on if you're B2B or B2C.
Thanks, Mikko. A question regarding the difference between traditional VC and corporate VC. When do you recommend going to one of the other or the other, and what would be the advantage and barriers for entrepreneurs?
Right. So there again, I think it's an excellent question. It's a to-the-point question, especially because my personal experience is that corporate VCs actually make better returns than many early stage funds because they have flexibility. They're not restricted to a 10-year life of a venture capital fund, but they have the flexibility to come into the VC market when the bottom is behind, and when the supply of capital, when it peaks, the corporate VCs are the first ones to close their taps, which the 10-year funds are not able to do. So I have huge respect for corporate VCs because of their agility and their ability, in my mind, to make better money than many VC funds would do. That's one angle. Then the other angle really is there used to be a way of thinking that you avoided corporate VCs until your pre-IPO fundraising, and even then you would rather not take a corporate VC onto your board because you could get tainted. I think that thinking has changed a little bit now, especially because there is so much corporate venture capital out there. But my recommendation, and this is just me, is instead of taking one corporate venture capital, I would take two. Then in a way, they would balance each other out, and you would not have a reputation if they were a 5% shareholder that, look, hey, you belong to that and that group because they're one of your shareholders. So take two, and ideally, do not give them a board position. Observer, yes, but not a board position, because what I've seen happen with some of my boards, when you have corporates on the board, they will push your R&D and IP development in their direction, which you may not necessarily want to do. So it's a delicate balance, but I would certainly be open to taking corporate venture capital money. It is different kind of money than the fund, and be very, very careful if you have a commercial agreement with the same company where you're taking corporate venture capital funding. Those two agreements, they should not be tied into each other in any way at all. So if the corporate VC comes in with plain vanilla terms similar to what a VC fund would do, go for it.
Mikko, if you do not have a market validated product yet, does it make sense to go for a Series A funding?
I'm sorry, what were the first words that you said? If you do not have what?
A product that is validated by the market.
Got it. Okay. So I'm assuming it means that you are pre-revenue, you don't have any sales. And I've raised a lot of capital for companies that don't have any sales, that are in a pre-revenue stage. But in order to succeed with a Series A, and it may be pushing it, as a minimum, you need what I call a minimum viable product. The key IP has to be up and running. And I would say that you need to have one or two pilot customers, even though they're not paying customers. I think those pilot customers, they should do three things, which are the core of your investor presentation. They should explicitly speak to the problem that they have. And then you, together with the pilot, you should describe what your value proposition is. And then the third point is the return on investment for the customer. If they spend 100,000 euros with your technology in a year, how fast does the 100,000 euro investment pay itself back to the customer? And for venture capital backed companies, it should be less than a year. If it's 3 years, you may not get VC funding. If it's 12 months, you can get there. I've seen SaaS software companies that are able to demonstrate that a customer has 6 months ROI. I've seen 6 weeks. I've seen 6 days. So it's all about the problem, the value proposition, and the ROI. And you may be able to pull it off and argue those points without being in the market and having many paying customers. But if you are still developing your minimum viable product, my hunch is that venture capital funds may not invest. Angels may, and corporate VCs may.
Okay, thanks. We have a lot of questions regarding valuation. How do you deal with this topic in the first meeting with the investors?
There you go. So my recommendation is not to ask for a valuation in your investor presentation. Two things may happen. You may be overvaluing yourself and nobody will speak to you. But hey, I've seen many companies undervalue themselves and you're leaving money on the table. And suddenly you're below 50% after the Series A. In my mind, and I spoke earlier about that it takes just as long to get funding as you have a trust-based relationship with your investor as a person. I think valuation is the last thing that should be discussed. They should like you and you should like them. And then when everything else is done, then you have the valuation discussion. It's not your first point, it's your last point. Now, if you speak with many VCs, and if you're good enough to get 3 term sheets, I would ask the VCs to put down a valuation, and I would expect that 3 term sheets and the valuations on those 3 term sheets, they would be very close to each other. What I'm trying to say is that, hey, all of you have a market price. You just need to figure out what that market price is. The best way is to get that valuation from many VCs, but you could try and figure out what your valuation is by looking at similar companies that have had funding and find out what their valuations were. And for SaaS companies, I mentioned earlier, there's a SaaS exam in the appendix, and that's a very, very straightforward, clear 10-point SaaS metrics on how you should be improving your business through those SaaS metrics, and also how investors would approach valuation of SaaS companies. Obviously, it would be different for hardware companies. It would be different for pharma companies. It would be different for medical technology companies.
Thanks, Mikko. We are coming to an end. A last question, because you said you received so many investor presentations. What is the first thing you look at when you receive an investor presentation? What are you like opening the deck and directly looking at the technology, the product? What makes you keep looking?
Very good. So I'm referring to the 10-point investor presentation framework that I have in the appendix of this presentation, which I will not show, but it's there. And there's a couple of things in that investor presentation that I'm very, very hot about. For me, after taking a look at 5,000 investor presentations, all I need is an overview slide. And in that overview slide, you build a mini story of your whole deck, 7 bullet points. If you do a good overview slide, it's all you need for a 30-second elevator pitch. It's all you need for a 5-minute elevator pitch. It's all you need for a 1-hour discussion, a dialogue. Remember, music, song, and dance, a dialogue with the investor. that 1-page overview slide is your agenda for a 1-hour meeting. And all of your other slides, all they do is they support the overview slide. I would like to see a team slide early in the deck. Academic research in venture capital says that the 3 most important decision factors are team, team, and team. So think about the team and think about the skill sets that you have and what makes your team unique in the world, that you're the only team in the world that is able to solve a certain problem in the world. So bring out your skills and skill sets that you have in your team in a strong, positive way. Over and over, I've been mentioning that you do need a financial plan in your investor presentation. I would say that 80% of the investor presentations that I get out of the blue every week, 1 or 2, do not have a financial plan. But hey, I'm an investor. It's the financial plan that I'm investing in. So that should be included, although quite often it is not. And then what I mentioned earlier, what gets me going in the right direction is the articulation of an individual company's problem or an individual consumer's problem. So start building the story bottoms up, not top down. It's the individual problem that I'm highly, highly, highly interested in. And then what is your value proposition to that problem? And then the ROI. If the company spends 100,000 a year on your product, or if a consumer spends 100 euros or 1,000 euros on your product, what is the return on investment for your customer? So that, in my mind, is one of the cores of the investor presentation. And then, of course, you have the IP, the technology, the high barrier to entry that we spoke about, the system architecture, and all of that. So the key messages that I have, just to repeat, what I would need to make up my mind if I take a call from you or not. Overview slide, team slide, problem, value proposition, ROI, financial model. Those would be 75–80% of what I need in order to agree if I'm going to spend an hour with you next week or not.
Great. Thanks, Mikko.
You're welcome.
Those are nice words to conclude the webinar. I hope you enjoyed it. We have another event beginning of March, but I would love for you to give us some feedback and even propose some topics you would like us to address until the end of the project. I would like to thank you, Mikko, again for joining the event, and I wish you all a very nice afternoon. See you next time. The event is available for replay tomorrow. Thanks.
Thank you, everybody. We had almost 100 participants, which is the maximum size we have in Zoom. So
yes, exactly.
Thank you. And thank you for all of your questions. They were very, very spot on. Have a good day.
Bye.
Cheers.